Check it out, folks. We always talk about, when you follow the money and you look at who gets paid to sell what, when, where, and how, check out the financial institutions and what their marketing game is. And remember, it's important to, when you watch a commercial, see who's doing the commercial, see what product they're selling. And then once you could see what that is, you could then begin to figure out, okay, I'm not saying this is a good or bad idea, but does this sit and fit with my world? For example, let's get into some different topics or themes that we hear from time to time. And there's about 9 of them, so bear with me, but it's a really good learning experience. When we talk about compounding interest, right? So what does that mean? Okay, the magic of compounding. We hear that, that really smart dude, Einstein, I think he was the one that came up with the magic of compounding interest. And by the way, I'm not saying it's wrong. But here's what you need to know about compounding interest. Whenever you sit down with somebody, they like to show you what I call the mountain chart, right? And what does that mean? That means that if you started out with, let's say, I'll make up a number, $10,000 today, and if it averaged 7% every single year, every 10 years it's going to double. So that means in 10 years, that $10,000 will be worth $20,000. And then in the next 10 years, it'll be worth $40,000. That's the magic of compounding interest. Now, that works beautifully as long as you're not taking your money out. The second you start taking your money out, you're then subjected to what we call the sequence of returns rate risk, because the market just doesn't go up 7%. If you look at a chart of the market, even if it's trending up, there's a lot of ups and downs. For example, from 1980 to 2021, the average, rate of return in the S&P 500, where we're including the dividends getting reinvested, the average rate of return has been about 12%. However, the average intra-year pullback on average over that same time frame has been about 14% on the downside. 35 out of 42 years, though, the market has ended up. So the person that stays in it for the long term doesn't take any money out. Yes, you have to pay taxes on that growth, especially if it's an after-tax income. So you have to pay taxes from another part of your world, not take it out of the market. If, in fact, you could do that with discipline, which is like kind of, the odds of not happening or the odds on landing on the moon, where you're not taking money out, you're enjoying the ride over a 30, 40-year period. So compounding interest is true. However, it's important to compound your overall world. Now, the next thing we can talk about is dollar cost averaging. So what does that mean? That means that, once again, if I have $10,000 and I'm committed every single month to put $500 into the stock market, I have to do it in up months. And when everyone is telling me that the market's going down, I have to do it in down months. If I systematically stay into that model and don't deviate, don't take money out, everything I'm describing are really good savings and wealth accumulation tools. However, in this scenario, there's no protection from taxation. There's really, unless my intellect when it comes to the winter economically, where I'm not going to get scared and take money out of the market, which happens 99% of the time, these are really good ideas, provided I'm doing it for the long term and I'm really systematized and structured. Here's the other financial institution goal that they or product that they like to push is term insurance or group term insurance. So let me tackle this 2 ways. Term insurance does have its proper place, right? But when somebody tells you to buy term and invest the difference as an overall life plan versus, buy blended insurance and invest the difference, 2 different scenarios. One thing you never want to happen in life is your term insurance death benefit to expire. However, term insurance, whether it's a 10, 20, or 30-year term, eventually it expires, meaning the insured, the person that bought the insurance, is still alive even past when the death benefit expires, which means in retirement, you now have to live off the interest of your assets so you don't outrun your money, or outlive your money, I should say. Whereas if you have the right kind of insurance where the death benefit never expires, that death benefit being alive in retirement allows you to spend down your assets, knowing the death benefit's going to replace it. That requires proper planning, cash flow analysis, budgeting, strategic at the high level. And by the way, if you have any questions, start putting them in the comments below. If you want to sit down with one of the members of Epic, go ahead, click that link. One of the members will sit down and talk to you with no obligation and take you through the success process, answer any questions that you may have. And sticking to the third part of term insurance and group term, remember, somebody will say, I got insurance at work and it's 3 times salary. Great. So if you make $300,000 a year, that means you got about $1 million in group term insurance. But guess what? The second you leave that job, you lose that insurance. So it's important to understand strategically what that looks like. Then we have payroll deducted. Number 4, payroll deducted qualified plans. Okay, here it is. And we talk about, and this really gets people burnt up. The 401k, right? It comes out of your check every month pre-tax, which means it's not a tax savings. It's a tax postponement that results in substantial lost opportunity costs, provides no liquidity, limits your investment choices, no lawsuit or disability protection, and when you take the money out after 59 and a half, it's all tax at ordinary income. Trigger alert, you're going to get insulted if you love the 401k, and let me apologize now, but if you retire and you have $1 million in a 401k, after taxes, after fees and inflation, it's probably worth about $600,000, and make sure you don't outrun your money. And now, if you're living off the 4% rule, because now you're taking money out, you're no longer putting money in, and it's subjected to the stock market, which, by the way, the stock market has made a historic run over the last 30 years or 40 years, specifically since 2008 when interest rates were low. They're now starting to raise interest rates, which means that debt instruments are going to be performing in ways that they haven't performed in the last 10 or 15 years. We also want to talk about the Roth IRA and the 529 plan. This is number 5. Remember, the financial institution is like it's like a car lot. If I was to go on a car lot, there's a truck I could buy, there's a 4-door sedan, there's a convertible, there's a two-door car, there's a van, there's all of these different cars I could buy. It's no different with the financial institutions. They give you products that sit and fit with whatever is going to be situational and specific. So a 529 plan is for college, right? A Roth IRA, which, by the way, I love the concept of a Roth because it's with after-tax dollars. The problem is it's so good, meaning the government can't touch the growth. They don't let you put more than $7,000 in. Think about that. And if you make too much money, you don't qualify. But they'll let you put a profit share and 401k plan together north of $59,000 or $58,000 or $57,000 a year because the government gets to tax that on the way out. Same thing with a 529 plan. If it's not used for college and you want to take it all out, you get a 30% penalty. I'm giving you a guesstimate on that because it depends on when that happens, but it must be used for college planning. And now that means the financial institutions get to keep your money. They get to hold it for as long as they want, or as long as they can, I should say, and then they give you back the least amount as possible. Because if you have a 401k that's $1 million, you're not going to cash that in. You're going to take yearly payments on it. Number 6 is low deductible, whether it's homeowners or car insurance, right? Or even your health insurance. So I know if somebody has a $500 deductible on a car, I'm going to speak in general terms right now, why not increase that to $2,000? You're like, why, Rob? Well, I'm like, if you have $500 deductible and you get an $800 fender bender, you're not going to submit that to claims, right? You're going to pay out of pocket anyway. You might as well get a $1,500 or $2,000 deductible because it's going to cost you less every month. And by the way, that savings from a $500 deductible to a $2,000 deductible, put that savings towards an umbrella policy that gives you a financial moat around your castle. Number 7, non-deductible loans and credit cards. Well, listen, we talk about the velocity of money multiplier all the time. We talk about how the banks, what they do is they don't take financial risk, they take credit risk, and they loan money out over and over again. And typically they loan it out in the form of high interest paying credit cards, as well as car loans, as well as mortgages. And they get paid over and over again by charging you interest, whether it's on a car loan, whether it's on a mortgage or credit cards. So that's how the banks do extremely well. Why not copy that? Number 8 would be mortgages of less than 30 years. And here's the thought there. If I'm going to do a 15-year mortgage versus a 30-year mortgage, but I'm a grown-up with a real game plan, and I still want to pay the house off in 15 years, I'm better off at doing a 30-year mortgage and taking the difference in the monthly savings, put it into a proper plan that's going to grow separate on its own so I can leverage that and buy other assets. And at the same time, when I get to the 15th year, I'll have enough money to still pay off the house. But one of the things I did magically was I was able to take advantage of stretching out not only inflation that's working in my favor, but also if I do a 30-year mortgage, the first 7 or 8 years are interest, whereas if I did a 15-year mortgage, that's a lot faster, which means once I start paying it down, I'd save less in taxes every year. Last but not least, and this is number 9, money myth we'll call it, where the financial institutions win first, and that's where they talk about you prepaying your mortgage loan. And they'll say something like, hey, if you make one extra payment every year on a 30-year mortgage, you'll save 7 years. That's good for them. But why is that good for you? Because remember, real estate values go up or down whether you pay your house off or not. Equity really has no value, no rate of return, I should say. It's really based on what your interest payment is. So at the end of the day, why would you pay extra to your mortgage so you could quote unquote pay your house off and get that title that says the house is paid off, right? But why not deploy that money into other areas that are going to give you guarantees, flexibility, and liquidity, and have that money work in a multiplier fashion? Anyway, these are 9 different myths. I should say not myths, but marketing strategic genius approaches that the financial institutions put on us every day, all day, twice on Sunday. If we take a clinical look and if we truly understand what our investment philosophy, what our strategies is on how we can multiply our money and not just compound interest in a bucket, but compound our overall wealth through strategic planning and positioning of dollars, well, we're well on our way. Once again, go ahead, click that link below. Thank you for checking in. Every day we're trying to drop education and knowledge. If you have any comments, add comments. If you want us to do other videos, let us know. And in the meantime, I want to thank you for checking out our channel. And once again, there's no obligation.